Welcome back to the Sovereign Soul Show, you divine lions and lionesses. What an incredible show we have for you today. Once again, returning is Dr. Peter C. Earle, now Director of Economics at the American Institute of Economic Research, a man who graduated West Point Military Academy, served as an officer in the U.S. Army Ranger Battalion, and over 2 decades on Wall Street, brokering, options, trading. He knows the system inside and out, bringing it to you here because we've got war with Iran. We have an incredible complete halt to silver exports. China and Mexico between 80 to 94% of the world's silver supply, and Comex inventories are running dry. Will it kick off 2 quadrillion to 400 quadrillion derivative debt collapse, the Fiat banking system? This is March Madness, and it could happen by the end of this month.
The world is now pulling the rug out from under the U.S. The dollar is going to collapse. The dollar is going to be replaced by gold. Central banks are buying gold to back up their currencies. True. They're getting rid of dollars. They're getting rid of treasuries. We are headed for an economic crisis, again, that will make the 2008 financial crisis look like a Sunday school picnic.
All right. So many people loved our last show. I'm absolutely grateful that Goldco allowed us to bring back on Dr. Peter C. Earle, the all-American badass. Remember, U.S. Military Academy, West Point graduate, U.S. Army Ranger, has his Ranger tab, talked about serving the greater good, and then MBA, PhD, economics, and a volunteer of the Ground Zero Army in 9/11. And this man just keeps sending it. And ladies and gentlemen, here is his book that he sent to me after our last show, which I'm really grateful for. There's the proof, because we know some people are like, really? Did he write it to you, Brad? Yes. And just amazing. Gold in uncertain times. And talk about uncertain times right now. Just in the last 4 or 5 weeks since we were on here, you had Venezuela. And when we had, Mexico, because Venezuela just happened, Mexico, Iran. And then now all Mexico silver imports are pretty much halted because of what's going on down there. Ecuador just launched last night. We see Shanghai futures that are $98. They closed on silver, yet it's around 84 in the US. So the precious metal wars are going on. We have a lot of people who are curious, like, what the frick? What's going on? What should I do? So you're going to hear it from the American badass and the PhD of economics over at the American Institute of Economic Research himself, Dr. Peter C. Earle. Welcome back, Pete. It's an honor.
Thanks for having me back. One quick thing, no Ranger tab. Ranger Battalion, but no tab.
Copy that. Copy
Got
that.
it. Okay.
Copy that. Yeah. Still more than me from the Canadian militia.
Okay.
Yeah, a little more specialized. Yeah, that's awesome. How have you been doing? First of all, how are you? How's your wife?
I mean, it's been an incredibly busy couple of weeks between gold and silver. More recently, you mentioned things that have been happening around the world. I mean, now we have Iran, we have oil, all of those things. We have what look like cracks in the private credit market. So, it's a time of upheaval. But I mean, it's a pretty good time to be an economist, neutrally speaking.
Yeah, an economist. And also, from my opinion, never been a financial advisor, medical doctor, never want to be one, or an investment advisor. Just got to put it out there. A great time to own gold and silver, and I'm fortunate to have a little bit of both, everybody. And we just saw the second largest country in the world by population, India, pull out of the LBMA, the London Market Exchange.
Mm-hmm.
What the heck is going on, and what does that mean for just focusing on that second largest country in the world with population, and also a massive economic engine for the global economy, pulls out of the London markets? What does that mean to the everyday teacher? Maybe we have on our audience, teachers, they're busy moms and parents going, they can't wrap their head around what the implications are just from that as we build forward.
Sure. Yeah. It wasn't a big surprise, but it was a bit of a surprise. I mean, this is very similar to efforts that have been made in the Middle East to create their own oil exchanges, like the Gulf Oil Exchange, that sort of thing. Basically, in recent years, India has been pursuing a lot greater domestic bullion infrastructure, not just getting gold and silver, but actually trading it there. So they've created something called the India International Bullion Exchange. And that's what they're doing there, is they're trying to bring in more gold imports, and they're trying to create price discovery there. So in the same way as you might have a company like Amazon trade on the New York Stock Exchange and also in London, India wants to generate its own prices for precious metals outside of what you might see in New York, Dubai, London, and Hong Kong. And what that might mean is that it might gradually reduce London's dominance in global pricing. And for if you're a gold or a silver investor, all it means is that there's a more multipolar market, more prices, which usually means better prices and more liquidity. So it doesn't mean any sort of disruption of ownership. It means more pricing mechanisms and more places where gold and silver is either being mined or coming through. They want more of a say. Yep. They want more role in creating prices.
Wow. Yeah, that's wild.
Yep.
And I've seen reports from India going back to October that,
Yep.
they're anticipating 550 an ounce silver. That's an anticipation that's not written in stone, everybody. But
Yep.
they're literally saying that this is my interpretation. We don't believe what London is doing, Comex is doing in the States is reflective of what the true value is. So we're just going to do it ourselves. And in our borders, this is what silver is to us, for example, right? And that's it. And talk about capitalism in its greatest form from a standpoint. That's wild.
Absolutely. Yeah.
Wild. All right. And I mentioned, like we just saw at the time of this recording last night, silver in Shanghai closed at $98.25. That's on the Shanghai Futures Exchange. And then silver in the States, we see a price run on it for suppression again around 84. So again, I use the pricing wars, precious metal wars continues. And yet again, in the CME, Chicago Mercantile Exchange, Comex had another technical outage on Wednesday, February 5th, but they were caught red-handed because a whole bunch of trades still happen. And just so everybody knows, they halted the trading on precious metals and natural gas. So, as Dr. Earle is saying, you're bringing in oil and gas. You have the Strait of Hormuz was closed last week by the Iranian Navy, which has now been decimated and removed by Trump and Israel. And Trump is backing up the merchants and saying that we will guarantee safe passage for commercial shipping in the Persian Gulf right now, which is incredible and virtually unheard of. So that's now happening. You have these constraints, but nonetheless, CME is halting trading due to technical outages yet again. Will we see some justice? Because I think that's a big signal to everybody that there's some real negative people behind the scenes doing
I mean, so these big exchanges, they handle the derivatives the total notional around the world annually comes to quadrillions, more than 1,000 trillion dollars. So there's a lot going through there. Most of the time when we have these outages, the exchanges, they create an audit and they look at both executed and attempted trades, and they try to determine whether any erroneous trades are made. They bust them if they do, meaning they don't give any credit for them. And while market participants sometimes suspect there's manipulation, I am not going to be the person to say that manipulation doesn't occur. I will never say that. A lot of times it's just operational or technical issues. But I do know that what I've noticed over, soon to be 30 years, doing this is that a lot of times, whether it's by randomness or for some other reason, the best trades wound up being broken. I remember when we saw the flash crash in 2011, a couple of my friends, not me, a couple of my friends got off trades at the low that the minute the market reopened would have been, really, really profitable. Those got busted. So, I mean, historically, most of these incidents are procedural fixes, but I can understand why somebody would say, isn't it interesting that this is happening just now? Now, there is an argument to be made that when there's high volume in a certain contract in a certain area, you have a higher likelihood of errors. But I mean, I don't blame anyone for raising questions. That's their right.
Yeah, definitely. And there's speculation going on that this is another Jane Street. There might be a class action lawsuit and silver pricing and fixing going on. That was just coming out here today, right before you and I started recording. And again, speculation, Jane Street, what they did with Bitcoin, now potentially happening in the silver markets. And kind of leads me into the next question, Dr. Earle, in Comex, because it's published, unlike what China did, they stopped publishing their silver inventories for just a few days, and now they just did it again, right? 2.3 tons of silver removed as of their last report. But 2.3 million ounces of silver were removed on Monday, withdrawn from Comex vaults. That is reported by Comex CME Group.
Right.
So there's there's now many speculating that there's an estimated 860,000 or so ounces from the report I saw
Yep.
that Comex, based on, we just take the last 12 weeks of all of the silver withdrawals from the Comex vaults at that current run rate, it looks like Comex vaults could be emptied this month at that run rate. And is that logical is question number one. And number two, if that does happen, what does it mean to silver, gold, precious metals prices, Dr. Earle? Should suppression come off in that regard?
So, I hadn't heard of those numbers, but that's interesting. I will tell you that the COMEX warehouse stocks, there's always speculation about how much is in them. It's very private. Historically, the system has been resilient, but it's important to remember that all vault inventories are divided into two major categories. There's what's called the eligible metal, which is stored but not necessarily pledged for delivery. It's being housed there, right? But it's not being hypothecated. And then there's what's called the registered metal, which is there, registered for delivery, all that sort of thing. The two can be divided or can be moved from one group to another very quickly. And in times of very strong demand, such as we see now, I mean, I don't remember a market like this for gold and silver since 2008, 2009 or so. Actually, that's not true, a little bit during COVID. But when there's periods of strong demand, that exchange sees metals flow between vaults, refiners, and international markets. And, usually what happens is we see a static inventory and we don't see the dynamic movement. So, I mean, certainly when things disappear, they get called back home, so to speak. The prices tend to go up. There's scarcity for lending, that sort of thing. But in the broader market, when you talk about London, Shanghai, and all that, it's a pretty big market. They usually do pretty well. It's not even the big moves. It's the sudden overnight moves, right? Yeah. When we move $20 at a time, like we have in silver and gold. Yeah. That's when you start to see these sorts of shortages show up.
Yeah, amazing. Yep. Thank you for that. And then Gold Fix, I announced this on the show we just did Sunday. Not we, as in you and I, we, my audience. And Gold Fix reported that J.P. Morgan's desk called the possibility of $9,300 an ounce gold at the end of this year, and they literally put into the report approximately $9,300 an ounce gold as a monetary reset. That is from JP Morgan Chase Bank. So number one, that's pretty amazing. Number two, how did these desks forecast to such a price? Again, for that individual in the audience, the hardworking mom, dad taking care of the kids, and they're sitting there going, well, what is it that they might know to set a potential forecast for that for 9,300 an ounce, where we're sitting here today, it's just over 5,000.
Sure. So the big banks and trading desks, they occasionally publish scenario forecasts to illustrate the potential outcomes under certain conditions. I hadn't read that report, but for gold to approach something like $9,000 an ounce, I mean, those models would probably assume something like rapid monetary expansion, a sharp currency depreciation among a very, and not just of any currency, one of the top, say, 6 or 7, financial instability, maybe a major shift in reserve management. So, comparing gold to the global money supply or sovereign debt levels, usually what you get to come up with that kind of a number. That doesn't mean that's the base case, but certainly it represents a tail risk or a stress scenario outcome. But look at what we're living with now. We're living in an era when tail scenarios happen more frequently anyway. So, in practice, gold forecasts tend to cluster far lower, but this is banks and analysts saying, large macro shocks could occur, and if they do, they could move precious metals prices very rapidly. And we saw that in the last, just 3 or 4 months with gold and silver already. I would say we've already seen tail scenarios occur.
Yeah, I mean, gold has doubled where it was from a year ago. Yep. And then you look at January 1st, 2023, gold is $1,825 an ounce. Yep. So, in the last few weeks, we've seen it get up to 5,400 again, and it topped 56 just recently. So yeah, in your book, by the way, once again, link is below here. Everybody's watching this show, to the Amazon for gold and uncertain times. You also mentioned in 2021 and during COVID, there was about 3,000 tons of gold that were in supply, but central banks at that time had about 35,000 tons of gold. So you have a multiple of over 10x the amount of annual supply of gold, which is put into the world, whether it's jewelry, industrial, and whatnot. And that was 2021. In the last 2 years, you, me, many other people, we have just seen an explosion from especially the BRICS countries gobbling up gold by tens of thousands of additional tons. And it's almost like they're stripping it from retailers in a way, so to speak. So, just your overall comment on that. I forgot to add that to it, but 3,000 tons of annual supply sent 2021, and that's pretty much static that you reported here in the book, and that's about 3,000 tons a year that we can get, but they're buying tens of thousands out of the vault.
Yeah.
So just
I mean,
curious
what I think is that, the amount of gold that's being bought by central banks right now is a referendum on two things.
Okay.
First, it's a referendum on basically how widely used the dollar is and their recognition that if there's a problem with the dollar, they'll get pulled along with it. Again, whatever you think about Ukraine and about Russia, the decision to kick Russia out of SWIFT banks, out of the SWIFT system, had basically created an awakening among many countries around the world, including many U.S. allies, that using the dollar is not a risk-free proposition, and they need to, and many of them have decided to hedge against it. The other is a recognition that the dollar has become, to me, the demand for gold by central banks is also an indication of exactly how much the dollar has fallen in international regard. I mean, even when we had, even during the Cold War, the Soviet Union, our avowed enemy, right? They would use the dollar. Right.
Yeah.
But we have even allies now, like the UK and France have tested trading in other currencies and also have been buying gold rather, to hedge away from their use of the dollar. So I mean, that to me is what all of this buying by central banks tells me, is that there's a real urge, there's a real instinct to hedge against dollar exposure because of our high debt, because of some of the other things that have been happening, high deficits, and so on. So it's a remarkable period in history, economically speaking.
Truly remarkable. And I just saw last week a publicly traded company, so private sector businesses are allocating into physical gold and silver to hedge against literally economic uncertain times. So where you have crisis in the Middle East, you can literally call it a crisis when people are sitting in Iraq on a soccer field. Saw a video last night, missiles are flying over them from Iran into Saudi Arabia, Kuwait, F-15 jets getting shot down in Kuwait, unfortunately by Kuwaiti fighter pilots, as we saw reported, and naval warfare at a degree that you haven't seen since World War II going on right now. Torpedoes, see the ship blown up by a torpedo. I mean, I had goosebumps, like, my goodness. And then, we have cartel wars, right? Mexico, Ecuador, US SOCOM has acknowledged that is active right now. Cuba, that reparation is probably going to happen, likely going to happen very shortly. They keep putting it out, State Department, the White House, right? And then you see the continued collapse of the Federal Reserve banking system dollar, yet everybody allocating, the big banks, the hedgies, the hedge funds, into gold. And I just want to, once again, for the audience, remind you, we were brought together thanks to our partner Goldco, and the link's right below here. You can see it on the screen. You can get a free call with them. It's available in America only. A free call with Goldco. I would invite you to book that call, make the call, book the call, maybe bring your investment advisor, your stock portfolio advisor, your husband, your wife, whomever to that call. Plus, there's a link for a free report on gold and silver so you can get educated, get informed, and make decisions, because who knows? Maybe gold will be 9,300 an ounce by the end of the year, or much, much higher. Kiyosaki thinks it could be $27,000 an ounce, and that's a guy who owns 2 silver mines in America and a gold mine, Robert T. Kiyosaki. All right. It's freaking awesome. We really appreciate Goldco for doing all of this. So, Dr. Earle, 1970s gold, where we saw after Nixon took everybody off the standard, $35 an ounce. And in less than a decade, less than 10 years, it rocketed to about $850 an ounce. So that is a price increase of 2,330%, about 23 times higher in less than 10 years. That's an insane parabolic move in under a decade. And just in the last several weeks, we've seen in futures, in Comex, on gold, It was a week and a half ago, 11,000 contracts. It's now about 15,000 who are betting on gold prices, 15,000 an ounce, 20,000 an ounce, not 5 years from now, not 2 years from now, by December, 9 months from now. They're betting 15 to 20,000 an ounce future and you were a trader. You just remind everybody again on the background that you've had in Wall Street to be where you are now, because this is blowing my mind.
I spent 21 years as a trader on various desks, trading equities, options, futures, all that sort of thing at various levels. So I'm pretty familiar with these markets. Were you asking about those, about the options that are so far out of the money?
Yeah. The setup just kind of like I trailed off there for a moment. Like what kind of buyers then, with your experience, with what you know, what type of buyers would be pouring millions and millions and millions of bucks into these bets that gold will triple or quadruple in just the next 9 months to maybe 20 grand an ounce?
So I didn't even know that there were contracts that far up. But if there are, and if you say there are, I believe it. When you buy far out of the money calls, what you're doing is you're essentially placing a bet for a very, very big move. But what's important to know about far out of the money calls is that they're usually very, very cheap. So they could be a penny, 2 cents, 5 cents each for a contract. And what that means is that you're basically getting exposure to a really, out of the ordinary likelihood, or I should say, a really extraordinary a tail event, something that's extraordinarily unlikely.
Like an outlier.
Right, like an outlier. You're getting exposure to it at a very, very cheap price. So when you see people buying those, they're saying, look, if it doesn't happen, what am I going to lose? A penny or two a contract? If it does happen, the thing's going to blow up. And here's the thing about options. If you bought a 10, 15, $20,000 call, 20,000 struck call on gold, it doesn't even have to reach that level. It could reach a quarter of that level, a half of that level, and the premium is going to increase. So the thing is that, there's oftentimes currency stress, runaway inflation, systemic financial stress, worries about that. A lot of institutions will allocate a certain amount of their portfolio to these really far out of the money calls or far out of the money puts, just because they're cheap. If they expire worthless, you don't lose very much, and you do have some exposure if something extremely extraordinary happens. So I would say that activity in those contracts doesn't guarantee or even point to the likelihood of it. It shows that at least someone out there or some class of market participants are at least considering the possibility.
Wow. Yeah. Gotcha. Thank you very much. Yeah. So a little bit more of it's more like the Silicon Valley, like the venture capitalist versus the angel investor. And they're sitting here and they're like, okay, I got 100 million. So I'm going to take 10 companies. I'm going to bet 10 million each company. I might lose on 9, but the one that I put in 10 that becomes 10 billion, that's my winner, right? There's that type of horse. Yeah. Okay.
It's like that, or it's also if you ever go to the racetrack or whatever, and there's one horse that's 1,000 to 1. How can you not take that horse?
There you go.
You've got to, because you pay a penny for it, and if you win, you retire.
Yeah. Great summary. Well, I appreciate it. I appreciate it. Thank you. We're also at a time that, by some estimates that I have read in periodicals, investment periodicals, to Bloomberg, to all the kind of name brands that we might be familiar with, that China's silver exports, roughly up until January 1st of this year, is roughly estimated at 60 to 70% of global supply. Mexico silver concentrate estimated at 20 to 24% of global supply. So if we take 60 of China at a floor, right? So 60, let's say it's only 60 of the world supply of China and 20 in Mexico. That's 80% of global supply, annual supply, just silver alone. And those are pretty much gone right now to 80%. If it goes on the high side, it's 94%. Supply and demand, basic economics 101. Why do you believe we're not seeing that reflected in price right now on certain markets? Because these metals are not price inelastic.
Oh, yeah. Okay. So there's a few reasons. The first is that oftentimes futures markets are slow to react. When things happen, right, there's a lot of times that they move early or they move late because of lags, because of certain producers out there. That's one reason. Another reason is some of this is already baked into the market. To some extent, the market has already said the huge move in silver already recognizes that there's huge demand coming for silver. So some of those might be hedges, right? They might have already hedged, so we're not going to see much of a move in the physical market. And the other thing is just that, right now, a lot of companies have been buying ahead for a year or two ahead. So, they might be stocked up right now, and that's why we might not be seeing action, more action than we have already seen, which is considerable in the physical and futures markets. But that may come in the future. We may see more of a move a year or two ahead. And I know right now that a lot of firms, they recognize that they're very reliant on silver for certain applications, whether it's for EVs or for environmental technologies and that sort of thing. And they are trying very hard to come up with alternatives. But most of the alternatives, most of what makes precious metals precious is that there aren't many substitutes for what they do. So I could see a lot of them having hedged already, doing the experiments right now, doing research with metals that are atomically similar to either gold or in this case silver, and then that would play out over a few years. These things take a little bit of time.
Gotcha. Thank you for that explanation. It brings up a reminder to me of Herb Kelleher, founder of Southwest Airlines. He went out and he bet on the futures contracts to lock in the price for fuel.
Exactly.
And when all of a sudden the fuel prices went skyrocket, United Airlines needed a bailout from the federal government, or they're facing bankruptcy. Southwest said, our fares are cheap because guess what? We bet ahead. We bet against the futures markets and we won.
Right.
We called it and we hedged. Right. So, okay.
By the way, that's why we in the last few days have seen, kind of a very muted move in oil, but a huge move in natural gas. A lot of individuals, a lot of firms out there, a lot of funds were ready for something to happen in oil. They were already hedging, based upon what happened in Venezuela, and this thing now happened with the strikes in Iran. But where we saw a lot less hedging was in natural gas. And natural gas was up 45% yesterday, one of the futures markets, simply because Qatar closed one of their plants. So we can see the difference in being hedged and not hedged in what's happened in oil versus what's happened in natural gas in the last few days.
Wow, that's 45% natural gas.
Yep.
Holy mackerel. Yeah, incredible. From a precious metals standpoint, of course, since we're talking about this here, then, everything is hypothetical here. Where would you see, based on where we are with the US national debt load in the trillions, we have maybe 400 quadrillion was a report I had about a year ago, 400 quadrillion in derivatives, debt, whatnot, that is out there. Like, that's just a staggering freaking number for me, right? All in paper, all in ones and zeros on computers and tracked. And then what we're seeing now with the supply, demand, the squeeze, the maybe challenges going on with manufacturing and mining and getting more precious metals out of the ground, just in the US alone, right? As a critical mineral, not only silver, but everything else.
Yep.
Where, if you were forecasting something 100% hypothetical and conservative, where would you see, if you were the JPM desk and you went, no, here's reality, and here's the conservative level of reality a year from now, just based on everything today, what would you say?
I'm very cautious about picking prices. I would say this: if I'm watching what central banks are doing, and I'm watching the growth in industrial applications of silver, and central banks buying gold, and private companies buying gold, and all that sort of thing. I mean, I can't give numbers, but I do think that there's very little I see right now in the world that speaks to dramatically lower prices. Yeah. Now, something could happen. We could come to a global accord, and we could, there's these scenarios about sending rockets into space and dragging back an asteroid that's worth $20 quadrillion or something. You've heard about those.
I know a guy in Canada who started a company for that.
That would be disastrous for precious metals. That's a very, very far off thing. Even if it happened, by the way, you still have the problem of mining it and finding use, right? So I mean, it's kind of it's a fun science fiction scenario, but it doesn't mean anything. But I would say that between the direction of monetary policy, the direction of debt globally, the fact that we have not only in the U.S. we not only have this 38 trillion dollars in debt, but we have as much as 80 to 150 trillion in unfunded liabilities. We have things going on in the Middle East, all these other things. I would say all of that points to the high probability of higher prices over some time frame.
Yep.
I don't know what time frame specifically, and I don't know how much higher. Yeah, I mean, so look at the research reports, look at the options markets, look at the futures markets, look at how many forces right now are militating in favor, are urging or pushing in favor of a more inflated dollar, of higher inflation, of more debt. I mean, I don't see anything happening to push that back, to change that trajectory. So that's how I see it.
Yeah, fair enough. And just so the audience knows, I finally asked it. People going, ask him. Like, okay, it's done. So here it is. You have that at results. And historically, when you look back again, because precious metals, gold, that's something, especially gold, goes all the way back to the time of Egypt, Babylon, a store, value, sound money, liquidity for people, because it's easily to barter, easily to trade for folks, and it's an established value that the world can agree on. They might be off by a couple, $10 here or maybe $100 there at this stage.
Yeah,
the
thing is,
but
I don't know tops and bottoms.
Yeah.
I sometimes know cheap and expensive, but I definitely know supply and demand. And I know that there's very high demand right now from a number of different types of market participants for precious metals. And the supply is only slightly north of fixed. There's only so much gold or silver and silver in the world, only so much platinum and palladium, and only so much coming out of the ground. So that's how I would generally tend to answer those things.
Yeah, exactly. Yeah, we really appreciate that, Dr. Peter C. Earle. And again, Goldco, you guys can ask questions for them. Get the physical. To me, once again, the physical is what is key. You can get it, order it, bring it to your home, or put it into a vault and get some third-party insurance on that. If you want some more information, part of the report is in Gold in Uncertain Times is part of that report is like Goldco with their special report. Rather, I'm getting my reports going on my tongue here, Dr. Earle, pardon me, for silver and for precious metals, and a free call. So we appreciate them setting this up. And, my 2 cents in it is this, right? We have literally seen the fact that gold is so valuable. The American government in 1933 stole it from all the Americans with a barrel of a gun pointed at your head, which was literally, once again, the Gold Reserve Act that happened, as we all know. They said, here it is. You give us all your gold, or you go to jail for 10 years and up to a $10,000 fine. Hand in your gold at a Federal Reserve Bank. We'll give you a slip for payment and give you fiat currency. All that magically just appears out of a printing press. And then they repriced gold in 1934, gave it a nice little raise, and then said to the world, we're not going to pay anybody in gold in our debts, America as a country, but we want you to pay us in gold. We're going to give you currency, this little greenback, and you're going to give us this, not a silverback or a gold. Now we're seeing the flip-flop with everybody in the last several years. So I think it's very important to at least have it from a hedge standpoint. If people are in the stock market, they're in their IRA, and they've got their registered retirement savings somewhere, to hold physical precious metals 100%. It's only
diversification.
Yeah.
Right? Diversification, an asset that doesn't have a counterparty associated with it.
Yep.
A lot of good stuff to say about it.
Amen to that. Dr. Peter Earle, thank you so much. Appreciate you, sir. Appreciate what you do. Appreciate everything that you've stood for as well. Thanks for being here.
Thank you, sir. Great to be back. Appreciate it.
Got it.
All right, you sovereign souls, now is the time to protect your money with gold and silver if you already have not. And if you are and you have a chance to do so, I highly encourage to do so even more, because gold and silver will launch the golden age, which Commander-in-Chief Trump has continuously referenced.
The dollar is going down, and it's not a pretty picture, and it's not being sustained by proper policy and proper thinking. This was an opportunity, and maybe an opportunity to show people what's happening with the dollar so that we can do something about it.
Get some if you can. BuddhaLovesGold.com will take you to our partner Goldco. They have over 6,000 1,000 5-star reviews. This is why now is the time to buy gold and silver, because we have thousands of Americans buying gold today. The rising inflation has reduced our purchasing power. Dysfunctional politics don't work for us. The US dollar has lost over 97% of its value since 1913, while the price of gold has increased over 9,000%. Silver has fared well against the dollar too, with the silver price increasing over 4,500% since 1913. It's about wealth protection. Physical precious metals act as a hedge against dips in volatile markets. Go over to BuddhaLovesGold.com. That's www.BUDDHA, BuddhaLovesGold.com. You will download your free silver and gold guide today, and our great people over there at Goldco will take care of you. That's BuddhaLovesGold.com. You'll see a picture of me right on there, Brad Wozni. And once again, BRICS is the new financial system. Asset-backed precious metals is the way of the future. This is about financial control. Diversifying your assets with gold and silver puts you in control of your wealth at BuddhaLovesGold.com.